Hey everyone, this is Samuel Smith. I haven't been able to shoot any videos for a little over a week because I've been pretty sick with a bad cough and cold, but doing a little better now, so happy to be back in front of the camera and talk to you guys. Today I'm going to talk about 3 stocks that I would own if I could only buy 3 in preparation for the next recession. I think this is timely because there is some economic data that suggests that we could be in store for an economic slowdown, especially with ballooning credit card debt, some weakening consumer sentiment, rising unemployment. And so while the data overall is pretty mixed, there is a decent chance that we may face a recession in the near future. So hopefully these picks will be useful for you today. Everyone, before I get started in today's video though, if you could please give this video a like, I'd greatly appreciate it. Thank you very much. Okay, so the first stock that I would buy if I could only buy 3 in preparation for the next recession would be Virtu Financial. Many of you may have not have heard of it. It's a pretty obscure niche stock. Basically what it is it's a market maker. So the company, they are middlemen. They buy and sell stocks and provide that kind of liquidity. They deal with order flow from various brokerages like Robinhood or E-Trade, and that helps to create a more efficient market with more narrow spreads. But they use their advanced software technology to be able to profit from this bid-ask spread and providing that market-making liquidity. And so they tend to profit most when volatility is at its highest level. And there are 2 reasons for this. One is when volatility is high, that means that there are more transactions happening, and so they're able to capitalize on more of these bid-ask spreads. The second reason is when volatility is high, people are trying to buy and especially sell, typically like during a market crash, for example. They're trying to sell their stock really fast. And while they're doing that, it leads to higher bid-ask spreads because there's much more desire to sell than necessary to buy, so people are having to accept lower prices relative to what they wanted, and so there's a higher bid-ask spread to be able to take advantage of. Another reason we really like Virtu Financial is that they have a very asset-light business model. So they earn very high returns on invested capital, which means that they don't really have to invest a lot of capital to grow their business or to sustain their business. And so they're able to return a lot of capital to shareholders. And they're doing this both through a dividend that's very well covered by earnings. Currently yields about 3.5%, which is much higher than what the broader S&P 500 or NASDAQ offer. And even it's on par with what some of these high-powered dividend growth funds like SCHD ETF offer. And on top of that, it's buying back a ton of shares. In fact, over the last few years alone, it's bought back about 20% of its outstanding shares. So it's buying back stock very aggressively. So when you combine those 2 things with the fact that they have actually very attractive organic growth avenues in areas like crypto, currencies, options, ETFs, and other digitized assets where there needs to be a market maker, they're actually growing their business quite well with very high returns on invested capital. On top of that, they trade at just 9 times their earnings, which means they're quite cheap. And insiders are very well aligned with shareholders because they own a lot of the stock. The CEO has been buying a lot of stock recently, especially on the dip in the stock price earlier this year. And so while the stock has risen a lot lately, I still think it presents pretty attractive value. And most of all, I think it's valuable as a portfolio diversifier because if we do end up going into a recession and a lot of the earnings guidance and expectations are revised downward, with the market trading at such lofty levels compared to its historical averages, especially with some of these big mega cap top stocks like Nvidia, and Meta, and Alphabet, and Amazon, Apple, all trading at still quite lofty valuations, even though they pulled back some recently. I think we could see a market crash. And if that were to happen, it would really benefit Virtu Financial. And so it's a great portfolio form of portfolio insurance and diversification. You get a nice dividend yield and buybacks and growth while you wait. So I really think it's a great pick to own right now as part of a well-diversified portfolio. Okay, the second stock I would buy right now if I could only buy 3 in preparation for the next recession would be Barrick Gold. Now this is another stock that I was buying it quite heavily earlier this year when it dipped down into the low mid-teens, and now it's right around $20 a share. It's been rising a lot lately, which I expected to happen at least at some point because I thought it was so undervalued, but I still think there's a lot of opportunity in the stock because one, it's very undervalued relative to its peers. It's a gold mining blue chip stock. They also have a substantial copper portfolio that they're going to be growing in the coming years. And so they offer investors kind of the best of both worlds. So if the economy continues to go strong, China remains an economic powerhouse, copper is going to boom. And so their copper exposure is going to give them a very attractive growth vertical that I don't think the market is pricing in. But if the economy falters, we enter a recession, or say World War III breaks out, or at the very least China moves against Taiwan, and say the Chinese economy kind of collapses, the global economy struggles, prices of copper are probably going to plunge. But gold in such a scenario would soar a lot higher. And even if that doesn't happen, I still think gold's going to go higher because you have heavy deficit spending in the United States, Europe, and China, etc. And so that mega deficit spending is going to increase the desire for gold across the world. In fact, central banks have been buying gold hand over fist recently. You also have Federal Reserve rate cuts are very likely to happen this next month here in September and continue for the foreseeable future. And that historically has proven to be a major tailwind for gold because a lot of people, they want to put their money in short-term cash or bonds, short-term treasuries or money market accounts or CDs when interest rates are high because that's you're earning an attractive yield on your money. But when the rates get cut, that way of allocating your short-term savings or even your long-term savings to cash for the interest is no longer as appealing. And so gold becomes more attractive as an alternative. And so for those reasons, I think gold is going to go higher regardless, and it's been going a lot higher this year already. The other reason I really like Barrick Gold is that they have an attractive balance sheet, they have very little debt, they have a very good CEO who's been very disciplined about allocating capital, not chasing expensive acquisitions like some of their peers like Newmont have done. And on top of that, they trade at one of the cheapest valuations in the gold sector despite being a blue chip. They trade at roughly a 50% discount to Agnico Eagle mines. They trade at probably like a 15 to 20% discount to Newmont Corporation. And yes, they're more geopolitically risky. They have some exposure to places like Africa and Pakistan, which are more risky geopolitically than some of their peers. But the company has done that for a long time. They've got a really good track record of operating pretty effectively in those jurisdictions. And yes, it's a little bit of a riskier bet, but with the discounted valuation that you get, the other strengths, I think it's a worthwhile play. Again, I wouldn't overweight it at the current price, but I think having some exposure to it makes a lot of sense, especially given that we may head into a recession in which I think gold will benefit. And gold-related securities, especially when accompanied by interest rate cuts, will do very well. Just look at what gold miners and gold prices did in the wake of the last major recessionary and rate cutting cycle in around the 2008 to 2012 timeframe. The third and final stock that I would buy in preparation for recession is Enterprise Products Partners. Now, people who are regular viewers of this channel probably already know how much I like this stock, but for those of you who are new, or maybe this is your first video, or you just haven't seen my other videos on Enterprise Products Partners, let me give you a brief overview of why. The biggest reason I like Enterprise Products Partners heading into a potential recession is that they have a very, very consistent business model. They have consistently generated 10% plus returns on invested capital through all sorts of market cycles, through the 2018 energy market crash, the 2020 COVID crisis, doesn't matter. They continue to churn out very attractive returns on invested capital. Now, the reason for this is basically because they have very attractive long-term contracted cash flows for a very well-diversified portfolio. They also have a very strong growth pipeline that they're investing aggressively in. So when you have those two things working in tandem, larger economic fluctuations and even energy price fluctuations have relatively little impact on their cash flow generation and the profitability of their business. They also have a very strong balance sheet. In fact, the best in the midstream sector with an A- credit rating, which is the highest in the sector. Enormous amounts of liquidity. The vast majority of their debt is not due for over 10 years. In fact, the majority of their debt is not even due for 30 years or more. So I think their weighted average term of maturity is around 18 years. So very, very well-laddered debt maturities, very low risk of financial distress for any time soon. They have a very low leverage ratio of 3.0 times, which is among the very lowest in the sector. On top of that, they offer a distribution yield that's well over 7%. That's covered about 1.7 times by distributable cash flow. They've been growing that distribution at around a 5% CAGR and plan to continue doing so for the foreseeable future. They've also been buying back any of the equity that they've been issuing to insiders as compensation. Insiders own about a third of the company's equity, so they're very well aligned with insiders, and they have a very strong growth pipeline currently that I already mentioned, but in a couple years, about 2026, the vast majority of this is going to come online. These new projects arrive at causing a step size increase in their EBITDA generation. Meanwhile, their CapEx will likely fall some after that, so they're going to have additional free cash flow because they're going to be spending less on growth CapEx. And so when you combine these two factors, the growth and EBITDA, which will push their leverage ratio down significantly, with this extra free cash flow from both reduced CapEx and these new projects coming online, generating more cash flow, they're going to be in a position where they're going to be able to either buy back a lot of stock, their units, or they can grow their distribution rapidly or do a special distribution or engage in some very accretive acquisition. And given EPD's track record of allocating capital very effectively for unit holders over the long term, we can have confidence that management's going to use that capital very well to create value for us. After all, they're very well aligned. And so for those reasons, I'm very bullish on EPD pretty much regardless of what happens to the economy, but even in an economic scenario, because of their stable cash flow generation and their balance sheet strength and their upcoming cash flows that are going to be coming online that are pretty much all already contracted, these projects, I'm very optimistic that even in a recession, they're going to continue to generate strong returns and even growth and continue to grow their distribution. So I think it will significantly outperform the broader market and economic slowdown. So there you have it. Those are the three stocks. Before you leave this video, if you could please subscribe to my channel, I'd greatly appreciate it. I'm getting closer and closer to 3,000 subscribers. It would mean a lot to me if you would do that. Also share with me in the comments below what you think of these three stocks. If there are any that you would add, or if you disagree with these three choices that I had. Thank you very much. See you next time.